Hey guys, wanted to go ahead and make a video so you could hear me talk about Chapter 8, which is basically closing the books for a service business organized as a sole proprietorship. This has two sections, and the first one goes over recording closing entries. And with that, you have to make journal entries in the general journal and then post them, and they're called closing entries. This will bring various accounts to a zero balance, and we'll get more into that later, but the main goal is to have your accounts ready to go for your next fiscal period, which would be the next month. So here we go. Okay, so before you do this, you want to divide the accounts into permanent and temporary accounts. So anytime you have a permanent account, that means that whatever the balance was when you end one period will carry over to the next. So I think the best example of that is cash. So think of it this way. If you've got money in a bank account, let's say you got $100 in there. If you have the $100 in there on March 31st, it doesn't just disappear on April 1st. You don't have to start over. That is a permanent account. So permanent accounts would be assets that you have. So like cash, petty cash, your accounts receivable. And when you have a receivable, that means that someone who had an account with you, they still owe you that money. You don't just wipe that clean. So that balance would hang there. And then any value to your prepaid insurance, that value is still there. Your supplies that are still on hand, those are still there. And then your capital account, we would have already updated that using the current capital formula. So we take our capital balance that was in the general ledger, and then we add net income or subtract net loss, and then we subtract drawing, and that would be our new capital balance. Permanent accounts are sometimes also called real accounts. So moving on to temporary accounts, these are accounts that you use to hold values, and they're eventually transferred to the capitals account. So sometimes these are referred to nominal accounts. So your temporary accounts would be things like sales, expenses, and drawing. The reason we do that is because we have the accounting concept matching revenue with expenses. We've talked about that several times. Every time we have a fiscal period, we always want to say, okay, what revenue or how many sales did we incur? What was the value of those sales? And then we also want to match that up with, what were our total expenses? And our expenses are made up of, the advertising, miscellaneous, supplies expense, insurance expense, rent expense, and so on. But we use that to look at that period to say, okay, well, how much money did we have to spend to make that sale? So we don't carry over sales from month to month. We don't carry over expenses from month to month. We want to start with a clean slate because that is what's going to drive our business. We're going to use that to make decisions. Hopefully, if we have a net income, which means our revenue was greater than our expenses and drawing, we're going to add that to our capital account. So the money doesn't just go away, it gets transferred to the capital account. Same deal with drawing. And as we know that drawing is money that the owner takes out of the business for personal use, it's not classified as an expense because it's not being used to pay for, the generating a sale, but that has to be transferred out. The final account that we have not touched yet, you guys have seen it, is called the income summary. The income summary is what's going to be used to figure out what is the value that's going to go into capital. Okay, so need for closing temporary accounts. You will make journal entries into a general journal to basically set up how you're going to prepare closing out your temporary accounts so that they can be at a zero balance when you move to the next fiscal period. So again, the accounts that you're going to move back to zero are sales, all your expenses, drawing, and ultimately income summary. These must be zero before you move on to the next fiscal period. So for instance, if you have a sale total, so if your sales totals for the month was $5,000, we know that the normal balance for the sales account is a credit. So if we have $5,000 sitting as a credit in our sales account, the way to reduce that to a zero balance is we're going to have to debit sales for whatever amount the sales are. In this case, we would debit the sales account for $5,000. With the expense accounts, we know that they have a normal debit balance. Therefore, any expense account will be credited for the amount that is sitting in that expense account. Withdrawing, that is also a normal debit balance, so we would have to credit that account. And then income summary doesn't have a normal debit or normal credit balance. It just depends if you had a net income or a net loss, and we'll get into that as we go along. So going into the income summary account, as I just mentioned, if your sales revenue is greater than your total expenses, you have a net income. Therefore, your income summary would have a credit balance shown in the T account. It looks like this. So your income summary account here, you've got debit on the left. Those would be your expenses because they have a normal debit balance. And you have credit on the right. And if the credit amount, if you take your total sales and it's $5,000, and if you add up all your expenses, and let's say they're $3,000, you would have the difference between those two. So $5,000 minus the $3,000, you would have a $2,000 credit sitting in the income summary. On the flip side, if you have a net loss, meaning that your total expenses is more than your revenue or sales, it's going to be the opposite. It's going to have a debit balance. So if we flip that and we look and see, let's say our sales were $2,000, but our expenses were $2,500. That means we had a net loss of the difference between $2,000 and $2,500. It would be a $500 net loss. Therefore, your income summary would have a $500 debit. This is an example of what this looks like. Oops. So in this example, it says, if you look at just start with the sales T account, walking through this, you can see on the right side, which is the credit side, sales had a balance of $5,820. So if I am going to clear out sales, I'm going to have to debit sales for that same amount. $5,820 would be my debit. We have talked all year about how anytime you have a debit, you have to have a credit, or if you have a credit, you have to have a debit. So in order to, again, close out sales, you can see where it says that new balance of $0. Because we had a $5,820 credit, our closing entry in the journal, we would debit sales for that same amount of $5,820. Because we have a debit there, we have to have a credit. And that's what we use the income summary for. It's kind of like a little catch-all account to make these transactions flow into capital. So because we debited sales for $5,820, we are going to credit income summary for $5,820. So the closing entry for income summary, we would credit for $5,820, and that's basically taking that money out of the sales to bring it back to zero. So what this looks like here is you would say, okay, we had this top area that you're looking at right here. This is a sample worksheet. So this would be the left side of the worksheet where it lists all of your account titles. So this is just showing sales. And then this would be the income statement over to the far right. So this is showing sales had a credit balance of $5,820. When we do our closing entry, you'll go to your general journal page shown down here. In this instance, it's page 3. Anytime you do your closing entries, you would put these right below your adjusting entries. And you remember we went over how to do adjustments in the chapter before last, so it would have been chapter 6. So you'd have your adjusting entries listed where we adjusted prepaid insurance to insurance expense, and we adjusted supplies to supplies expense. So right underneath that last line of the adjusting entries, you would put the words closing entries, and you would center that. So if you're using Google Sheets that I sent out, you would type closing entries under the account title, and you'd center that. Now, the examples I gave you, I don't have the adjustments page there, so it's going to be at the top of the page, so you won't see the adjustments. So to make this closing entry, what you're going to do is you'll see right here, sales has been debited for $5,820. That is this to bring the new balance to 0. So that is our debit line. We don't have a post reference or anything like that yet because we haven't posted it. And then income summary would be our credit. And again, we're going to credit income summary for that amount to hold it there until we eventually flow this to capital. So you would indent income summary and you would put 5820. We don't have a source document for this. The source document, as we know, is indicated right here because this is a closing entry. We're going to get this information from our worksheet. So those are our heading for closing entries. You always put the date. The reason you don't have the month and the year here on this example is because they're saying that it was like right underneath the adjusting entries. Now, when you do your work on your pages, since it's like it's at the top of the page, you would put the year and the month. So again, when you do your closing entries, because you don't have the adjusting entries above it, and it's a new page for you, you're going to want to put the year and the month. So that it's just showing how this information flows. You would debit sales to clear it out, and then you're going to credit income summary. This next section goes over closing entry for income statement accounts with debit balances. So the two types of accounts that we would have debit balances for would be our expenses, which is shown here, and then also our drawing account. So in this example, you can see all of the advertising, or I'm sorry, all of the expenses. You've got advertising, cash short and over, all the way down to supplies expense, and their amounts are listed here. So again, this is a sample of the worksheet. This would be the far left of the worksheet. This would be the income statement. So these have already been adjusted because you can see we have an insurance expense and we have a supplies expense. So it's not showing us the adjustment columns. We've already done that. So because these have debit balances, to clear them out, we're going to have to credit them. Now, we know that when you look at this, if you had an actual worksheet here, you would have underneath here, it would show you the total amount for the expenses. But if you added those up, what it would show would be this amount right here, the $26.58. So taking your advertising expense all the way down to your supplies expense, and if you add up those debit values, it comes to $26.58 here. So because these are debits, our closing entry, you're going to put the date again. Your income summary is going to be the debit. Because we're crediting these, we have to put that debit somewhere. So this number is adding all of these up. So if I were you, what I would do is you could either put an equal sign in this cell and type in equal sign 397 plus 1 plus 80, and so on. Or what you could do is type income summary here, leave this blank. And then underneath it, you would want to list all of these credits to close out these accounts back to 0. And you would list them, advertising expenses 397 is shown here, and so on and so forth. Once you list all these out, what you could do is go back up to this cell right now for the income summary and hit an equal sign, and then do an auto sum and grab all of these, or you could hit equal sign this cell plus this cell plus this cell, and so on and so forth. But these numbers added up together must be the sum of this number. That's the amount that we would want to debit the income summary for. So again, you put the date, income summary, debit amount, and again, that's the value of the total expenses. And then you're going to credit these to close them. Okay, so the last thing you have to do is you have to close out the income summary. And this again, this is a closing entry on your general journal. And basically what this is showing you is, this again is the worksheet. So we know that there's a net income because we can see it. We can also see that this is the value of the net income right here, 3162. But you got to think back, where did we get this number from? The way we figured this number was you took your sales right here, because on the income statement, the credit, this is our sales value, and if you go back to the slides, that was the value of our sales revenue, $5,820. And our total expenses was $26.58. So we know that revenue is higher than our expenses, therefore we would have to put this as a debit, and this number is the difference between these two. So it would be $58.20 minus the $26.58, and there you get the $31.62. So on the worksheet, you would add those two up. So what this is saying is, when we do our general journal closing entries, Income summary is going to be sitting there with a balance of 3162 as a credit because you had credited for 5820 for the to close out sales, and you had debited income summary for 2658 to close out the expenses. Therefore, right now it actually has a credit balance of 3162. So to bring income summary back to zero, you would want to debit income summary, and then you can see here you would credit capital by that net income amount. So when I say that, like when you have a net income, it eventually flows back to capital. This is where that happens. So your income summary would be debited for that amount, and your key credited. So again, you would put the date. Because you had a net income, you would have to debit income summary to close it. And you would credit capital. So that's going to increase our capital account by 3162, which we already know, like from our financial statements. This is where some of that comes into play with the current capital amount. Shoot. Okay, last deal. You have to close out the owner's drawing account. So in this case, if you look up at the top here, you can see right, in order, you've got capital and drawing. In this case, Michael Delgado is the owner, and he took out $1,150 out of his business during this time period. So that's sitting there as a debit. When you close out drawing, you don't have to use the income summary. The income summary, you just use the sales, revenue, and the expenses. With drawing, we're actually just going to close it out by putting it directly into capital. So because the drawing account is a debit, to close that drawing account, we would have to credit it. And you can see that credit right here. But again, anytime we have a credit, we also have to have a debit. So what we're going to debit is the capital account, because when he took this money out, it actually decreased the value of our capital by that same amount, $1,150. So when you do this, you're going to put the date, and your debit would be capital, because that's decreasing our capital amount. And you're going to credit drawing, because it had a debit balance. To get that back to zero, you're going to have to credit it for that same amount. Okay, audit your understanding. I know you guys can see the answers to these questions because I already gave it to you, but just to provide some explanation. What do the ending balances of permanent accounts for one fiscal period represent at the beginning of the next fiscal period? So when we talk about permanent accounts, I want you to think of cash, petty cash, your accounts receivable, your supplies, prepaid insurance, and then also your capital account. So these are things that we're going to move from one period to the next. So this is going to be a representation. It's going to be the beginning balance. So if you have an ending cash balance of $10,000 on the 31st of March, April 1st, that money is not going to just disappear. You're not going to put it somewhere else. It's going to be the beginning balance of April 1st. Same thing with accounts receivable. Those companies are still going to owe you the money that was shown on the account before. And then again, also with your capital, which your capital has been updated because of this closing out of the temporary accounts. Next question, what do the balances of temporary accounts show? Well, that's going to show you whether you had a net loss or a net income, and it's going to say those things are going to flow into the capital account for that fiscal period. So if you had a net income, it's going to increase your capital with a credit change. And if you had a net loss, it's going to decrease your capital with an overall debit. And then the floor closing entries. The first thing you have to do is close the income statement with credit balances. So the only balance you're going to see on the income statement that has a credit balance is going to be sales. Okay? And think of the income statement, talking about number 2 now. If they have a debit balance, that's going to be you're going to close out your expenses. So just talking about these two, this is where the income summary first comes into play. So when you have a credit balance in your sales, in order to bring that back to zero, you're going to have to debit sales. When we debit sales, we're going to credit income summary. With our expenses, which are the debit balances on the income statement, Those all have debit balances. So to close those, we will have to credit each account for the amount that it shows as the balance. And then we're going to take the sum of all those expenses and credit it. I'm sorry, debit. You would debit income summary for that amount. Step 3, we're closing out the income summary account. And if you have a net income, your income summary is going to have a overall credit. So you're going to have to debit income summary and credit capital. If you had a net loss, your income summary is going to show as an overall debit. So you would have to credit income summary and debit capital. And then step 4 is where we close the owner's drawing account, which we know has a normal debit balance. To close that, you would credit drawing and you would debit capital.